Hi everyone, can you hear me? Yes? Yes or no, guys? Can you hear me now? All right, guys, let's start. Okay, today we are talking we are talking about your pricing convention, discounting, and arbitrage. Small chapter, no, not a very big chapter, right? Uh, what is important to understand here is there are some conventions which are followed in the industry, right? So the name of the chapter is pricing convention, discounting, and arbitrage. All these concepts are not those concepts which will be asked directly, right? Nobody will ask you, tell me the pricing convention. Nobody will ask you, tell me how to do discounting. Nobody will ask you, tell me how to do arbitrage. These are kind of the building blocks, right? Kind of building blocks for your future chapters, right? So when you talk about your fixed income, when you talk about uh, any concepts related to interest rates, you need to understand what are the pricing convention which are followed in the industry. So these are the kind of rules and regulations which are established in the industry, right? And these are followed in the industry, right? These are very popular methods, right? People have been following it, we have to follow it, right? There is like, you cannot say no, I don't want to follow this, I want to follow something else, right? It's not like that, right? We have to follow certain rules and regulations which are established in the industry. Those are called pricing conventions, and then we'll talk about discounting and arbitrage. So all the concepts in this chapter are indirectly related, very important, but directly they are not so important. Okay, so let's start. Okay, guys. So and then we'll do next chapter also. There are two chapters we have to do, guys, today. Okay, moving on. So first of all, fundamentals of bond valuation. When you talk about fundamentals of bond valuation, bonds are what? Bonds are those kind of your assets, those instruments, right, which have a certain amount of cash flow, right? So bonds, what do they do? Bonds have a cash flow, right? Periodic coupon payments, right? When you talk about bonds have a periodic coupon payments, right? So I think we have discussed earlier also, but if ultimately you have always make a timeline. So if you say that there is a 5-year bond, right? So you have 1 year, 2 year, 3 year, 4 year, 5 year, right? So every year, right, bond will give you some cash flow, right? Which will how will we define the cash flow? Cash flow will be dependent on your interest rate, right? So there will be a periodic coupon payment, and at the end of the year, there will be a kind of principal payment, right? So let's say there is a bond which has $1,000 principal amount, right, and that pays a 7% interest, right? If there is a 7% interest on $1,000 bond, right, so it will be $70 coupon will coming here, 70 is coming here, 70 is coming in third year, 70 is coming in fourth year, and at the end fifth year 70 is coming, as well as on the fifth year your $1,000 are also coming back. Now once you have made the timeline, then we already know, right, that any cash flows we have to discount it, right? One, two, if we have to find the present value of the bond, it is all about discounting. $70 discounted, $70 discounted, $70 discounted, $70 discounted, and this 1,000 plus 70, 1,070 also discounted, right? Obviously discounting will give them different values. Why? Because there are different time periods, right? Different time periods. So the formula which is given here looks a very hi-fi formula or looks a very difficult formula, but it's not a difficult formula, right? Ultimately you are doing what? You are taking the different cash flows at different point of time, and ultimately you are discounting those cash flow, right? You're trying to get the cash flow value to the initial part, right? Initial the starting point, right? That's what you're doing. So estimate all future cash flows, which I did here, and determine appropriate discount rate. Now who determines the discount rate, right? Who determines the discount rate? See, discount rate depends on your spot rate, right? Basically spot rate. What are spot rates? Spot rates are those rates which are based on zero coupon bonds. Spot rates are the rates of zero coupon bonds for a particular thing. Do the spot rate same stay same for your every year? No. Spot rate for 1 year will be very different from spot rate for 2 years, spot rate for 3 years, spot rate for 4 years, spot rate for 5 years. So spot rates for each year are very different, right? So spot rates are calculated from the zero coupon bonds, right? So again, very interesting concept which will come ahead in your curriculum. So we'll talk about it. But right now, very basics. Please understand. for any fixed income instruments which has a coupon. The coupon can be yearly, semi-annual, depending on the question. Here I'm just considering, let's say there is a yearly coupon in my example. So I took on that, okay, yearly coupon is there. So 70 was the coupon, it was coming. Let's say I tell it that it's a semi-annual coupon. Then I have to make 10 time periods, right? 5-year semi-annual coupon. Let's say I tell you 5 years and I say semi-annual. Guys, I write SA, semi-annual coupon. Right, is to start form. Semi-annual coupon means now 5-year semi-annual coupon means there are 10 time periods now. 1, 2, 3, 4, right? 5, 6, 7. Pardon my drawing. Maybe I should have drawn better. But think of these are the equal time periods. So what I'm trying to say, now if I say 7% per annum interest, always remember in FRM interest is always 99.99% is given in per annum only, right? So interest is given per annum. Now my coupon of the year is 70 only, but since the coupon is coming semi-annual, so my 1-year coupon doesn't change. 1-year coupon is still 70, but since the coupon is now semi-annual, it means $35 will come in 6 months and $35 will come in next 6 months. So what will happen is, that's why I have 2 time periods now, 10 time periods out from the 5-year. 35 will come here, 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 and last time 1035 will come. Now there is a difference. See, the basic concept in finance is time value of money, right? Time value concept says that ultimately, when are you receiving cash, that matters a lot, right? So please don't think that the value of a bond which is providing you $70 a year is same as the value of a bond which is providing you $35 every 6 months. No, it's not same, because $35 here will be discounted at a lower rate, right? Or lesser rate, because it's 6 months only, and this will be discounted at another rate, right? So the discount of both things will be different. Here you are discounting 70 at one rate, whatever the rate was. Here you are discounting 35 at one rate, another 35 at another rate, another 35 at another rate, another 35 at another rate. So since you are taking different rates, right, in your calculation, please note that you should clearly understand that you will not have same value, right? Bond value will not be same. Keep that in mind. If a bond is paying a yearly coupon, that has different value. A bond is paying semi-annual coupon, that has a different value. The value of a bond depends on its timing of a cash flow. If the timing of the cash flow are different, if the amount of a cash flow are different, you cannot have same bond value, even though both had your yearly coupon, yearly yearly coupon was 70 only, but the amount of coupon was same yearly, but timing was different. One coupon is coming at the end of 12 months, one coupon is coming at the end of half of the coupon is coming at the end of 6 months, and half of the coupon is coming after 12 months. So the point here is that coupon which is coming, right, are coming at different time. And if coupon which comes at different time, right, then it is very important to understand that we need to have different bond values, right? So bond values not only depend on your your coupon payments, the amount of coupon, but it also depend on what kind of cash flow it is coming, right? What kind of cash flow it is coming, it also depends on that. So keep that thing in mind, guys, very clearly, right? Don't kind of assume, right, that you will have the same value in both cases. It will never be same value in both cases. Keep that in mind, and that is a basic principle which you should understand about your valuation, right? That's your basic principle you should understand about the valuation, and be very clear. Okay, please remember that. All right, guys, so I think given more than enough context here. For treasury bond, R is the risk free rate, that's okay. right? C is the coupon, F is the face value, right? You should understand what is the face value because you will see a lot of value, face value, par value, etc. We'll talk about that. Don't worry. R is the discount rate, N is the number of period. For treasury bond, a risk premium is added to the risk-free rate. What are they talking about here is, see, when you are talking about treasury bond, R is considered to be the risk-free rate because treasury bond are considered to be quite safe. But if you take a corporate bond, let's say a bond of a corporate company, Apple, right, Amazon, etc., right, then you have to add a certain bit of risk-free rate, certain bit of spread on the top of risk-free rate, right, because the rate of interest will not be same in both cases, right? So keep that thing in mind very clearly. Okay, so that is what we have. Moving on, guys, right? Moving on. All right, calculating the value of the bond. This is what I was telling you, right? You have to be smart here and solve it. We can solve it quickly, right? Coupons are valued using the present value of annuity and the lump sum payment. That's okay. Annual coupon 100, maturity 10 years, face value 1000, discount rate, right? See, they have tried to do in a what you say, in a different way, right? You don't need to kind of do in that way, right? So it is uh, it's a long way. You can remember the formula if you want to do, but like personally speaking, I don't like formulas. Personally speaking, I prefer a very simple method that okay, if I'm getting 1000 is my face value, 8%, I am getting your $80 here, I will discount that. I am getting $80 here, I'll discount that. I'll get a $80 here, I'll discount that, right? So similarly, I'll get 80, 80, 80 for 415, 6, 7, 8, right? 9 and 10, right? I'm getting 80, 80. Last is 1080, right? So I'll discount that. That personally I'll do. But this question, if you have to solve in a shortcut way, right, then there is no other way than remembering the formula, right? Generally, if I'll be very honest, these kind of questions don't come in exam, right? People like me only set your paper, and we don't like to ask student question where there is no application of mind, where there is only rote memorization. We don't like, right? So this is like of a memorization, right? You can memorize it. C1 plus R divided by T, F1 plus R divided by N. You can memorize it and solve it. But personally speaking, I don't think such kind of question comes in exam, right? So that's we can keep in mind that way. Okay. All right. Okay. 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 All right. This applies whatever the value you will find out by this calculation, right? That will the value you will pay for the bond, which pays a $100 annual coupon, right? Okay, annual coupon was $100. Sorry, my mistake. I took it 80 because I saw that's a discount rate, guys. That's a discount rate. So coupon was 100, right? Coupon was 100. Coupon was not 80. Coupon was 100, right? Coupon is 100. Discount rate is 80, right? Discount rate is 80, right? And this is 1100, right? So I was telling you that we should follow a discount rate kind of thing, but uh, if you want to solve like this very fast, right? So I will solve like how? I will solve 100 discounted by 1.08 raised to power 1. Then 100 next cost cash flow 1.08 raised to power 2. Then 100 1.08 raised to power 3. Then 100 1.08 raised to power 4. Then 100 like this I have to do till last cash flow, right? Because this is basics, this is definition sort of stuff, right? So you do that, and you know like last cash flow will be 1100 1.08 raised to power 10. So if I, and it looks like a difficult question, but if you put in your calculator, things, it will move very fast, right? So it won't take much time, right? You can do like this also. But let's say if you're a student is who can remember the formula easily, right? Because I personally don't like to remember too much of formulas. But if you're a student who can remember the formula easily, then you can go for your this formula which was given, right? That's perfectly fine, right? Right, this formula bond price, right? Which right, you need to have C plus 1 plus R divided by T and F1 plus R raised to power n. And you can use this formula to calculate, right? This is uh, basically a present value using the coupons and the face value which has been calculated. Okay, fine. But such question doesn't come because this is like very basic. Nobody asks you such questions, right? Valuation with your semi-annual compounding, right? Semi-annual compounding. Why semi-annual compounding? Because normally treasury bonds are semi-annual bonds, right? So generally, I told you, right? I took an example of semi-annual initially only. So 100% annual coupon, I told you, right? $70, I told you, right? 70 will be 35.35. Similarly, this guy is saying that 100 will be like 50-50, right? 50-50 here, right? So what is happening here is the coupon is becoming two time periods. The 5 year time period had become 10 years, so 10-year here will become 20-year. You remember now? Previously, when I was showing you in the semi-annual, explaining you, what did I do? I took 10 time periods. Now, for 5 years, the time period had become 10. Now, because the coupon was semi-annual. This is what I did, right? Initially, when the coupon was annual, yearly coupon, there were 5 time periods. Here, there were 10 time periods. Why? Because the coupon was semi-annual, right? Same thing they are talking about, same thing, right? I've already explained you, same thing they are talking about, that 10-year becomes 20 time period. 8% rate will not be used now because rate for 6 months will be 4%. So please remember, your time period will be kind of multiplied with your 2. The I by y, I by y means your rate will be divided by 2, right? Your coupon will also be divided by 2, right? When you semi-annual, so that thing will happen, and again you can put that in formula. But personally speaking, formula doesn't come. Nobody asks you such kind of question in exam, but you want to remember, you remember. That's one point. Okay, all right, guys. Next point. Next point is your understanding of relationship between price and yield, right? So please understand that the basic principle in your bonds world, right? In the world of bond is that when your yield increases, the price of the bond goes down, right? One of the basic principle is that when yield increases, the price of the bond goes down, right? Price of the bond goes down. Very, very important, right? They're always inversely related. Yield, some people call it I by Y, right? I by Y, because in your financial calculator, it is given as a symbol I by Y. So if I by Y increases, your price of the bond, right? Price of the bond goes down, right? That's the thing. Bond yield and bond values and yields are inversely related. Discount rate increases, present value of cash flow decreases, bond price falls. When your discount rate, your I by Y decreases, your price of the bond increases, right? If you have to calculate the price in calculation, you have to take the difference value, a difference between present value and different discount rate. Please understand, higher prices when somebody will have, it will be low yield. Also remember that if we try to kind of make a uh, graph between your price and the yield, right? If you make a graph between price, this is price base, this is price, this is yield, right? If you make a graph between your price and the yield, that graph is curved, not a straight line, right? The graph is curved, not a straight line, right? Okay, right? Not a straight line. Okay, So remember that. And why it is curved? Because the relationship is not linear. Relationship is there is a curve, or there is some curvature in the relationship, right? And why there is curvature? Because there is a concept called convexity. Convexity, right? Convexity is the concept. uh, you know Convexity captures the curvature. Convexity is for curvature of this relationship, right? See, n- when we thought about it, we assume that the relationship would be linear, right? So linear relationship is given by a concept called duration. We'll talk about duration ahead, right? But the relationship was actually found out to be little curvaceous, right? Right? They were right. So how did this curve came, right? This difference from the linear. How did this curve happen? This curve happened because there was a another factor which come into play, which is called convexity. Important property affecting bond price sensitivity to yield change. The reason we have the curvature, reason for your curvature. Basically, the point is that it has been realized that when there is a major change, when there is a big change or non-linear change uh, in the prices, then the price yield relationship does not remain linear. It kind of become little curvy, right? And that change in the relationship is because those non-linear changes are not reflected by duration. So we need to have additional factor, which is your convexity, right? For option free bonds, right? You are, you it look like it is convex towards your origin, right? Looks like half of a smile, which is kind of right. Normally, it is curved, not a straight line, and all those things. These are all properties, right? These are all properties of the bond world that you should know. Okay. Please ask me if you have any questions. Next point is your discount factors, right? Discount factor. See, basically, if you remember what I did earlier, I wrote now like this: 100 cash flow I have, I will discount by 1 plus r raised to power 1. And then I have another 100 cash flow, I'll discount by 1 plus r raised square, right? And all those things, right? So, what I'm trying to say here is that sometimes people write this 100 divided by 1 plus r as 100 into 1 by 1 plus r. This part, when you break down 100 divided by 1 plus r into 100 into your 1 upon 1 plus r, if you break down this like this is called your discount factor. See, discount factor is this 1 by 1 plus r, right? So you are separating the cash flow separately. So what some people like, see, I was writing what cash flow for the first year divided by the discount rate of the first year. Some people don't note like this. Some people write cash flow for the first year into 1 plus r raised to 1. This part, right? This part is called discount factor, right? This part is called discount factor. General formula is given. So present value is equal to cash flow into discount factor, right? That we understand, right? Cash flow into discount factor, right? So discount factor is given to you for 0.5, $100 in 6 months. This is discount factor for 6 months, right? You multiply it, right? 100 into something something, you got 92.43. Nothing special, guys. Very simple basic concept, right? Very simple basic concept. Okay. Next is discount factors for treasury bills. Okay, what are the discount factors for treasury bills? See, what are treasury bills? Treasury bills, please understand, treasury bills are your short term zero coupon securities, right? When you talk about short term zero coupon securities, see, uh, treasuries, right? Treasury consists of your T bills, T notes, T bonds, right? We call something as treasuries. Treasuries consist of T bills, T notes, T bonds. So T bills is short term, ST short term, which is less than 1 year. Okay. Now, since these are less than 1 year, right? The the interest component is very small, right? The interest component is very small because less than 1 year, it is very difficult to kind of calculate the interest part here, right? So these treasury bills, right? These treasury bills are actually what do you say, represented, right? Actually represented in different ways, right? So that we need to understand. And uh, somebody can easily question and say, sir, why this, right? Why are you following this method? See, I am following this method because this is followed in industry. See, I have no love for this method, right? It is point is that people in industry follow this method, right? So people in industry have established this method and they follow it. And this is international convention, right? Internationally, this method gets followed, right? It is international convention, right? So it is like everybody in the world is following this method. Since everybody in the world is following this method, I'll also follow this method, right? So what is the thing here is that you generally uh, give your T bill, right? Either you represent T bill in cash price, either you represent T bill in quoted price, right? So there are two ways to represent your T bills, and you should know how to convert one to another. So cash price can be converted into quoted price 100 minus Qn by 360. So basically, point is very same, right? It is 100 is the price, Q is the quoted price, and N by 360, right? So if the bid is given, ask is given, midpoint 99.625, you calculated, discount factor, is given your 0.99625. So a security worth 100,000 in 80 days is actually worth 99.625, right? What we are trying to tell you here is that if we apply the discount factor multiplied with the whatever the security today, right? I told you, right? Cash flow into your discount factor, right, is equal to your uh, present value, right? So this is one calculation. But when I say this part, right, this is your convention. Just remember it. It will be used ahead, right? So don't forget it, right? 100 minus Q into N by 360. Okay. Moving on, right? Moving on. Discount factors for your treasury bonds, right? Discount factors for your treasury bonds, right? Earlier was your T bills. Now I am going for treasury bonds. I mentioned to you treasury notes also. Luckily, in your book here, they are mentioning mid or long term needs, means this treasury bond includes your T notes also and your T bonds also. So basically, they are considering both because they're considering mid also and long term also. T bonds provide periodic coupons and face value at maturity, right? Use T bonds prices to generate your discount function, right? How does it happen here is that once you know the cash flow, right? Similarly, cash flow, right? See, the cash flow which is coming to you is, if your cash flow is, let's say, 3.625, right? Then what are you doing? You are saying that, okay, I'm discounting this cash flow by 1 plus R1, right? I told you, right? Timeline. You're getting the cash flow here, you're discounting the cash flow. You're getting the cash flow here, you're discounting the cash flow. So if you're doing like this, and I say to you that, okay, let's say a T bond, which gives you cash flow, uh, what do you say, 6.76, 3625 is what, 6.75, 25, right? Let's say the interest is 7.25%, 7.25%, right? And I tell you it's a semi-annual coupon, right? So you will say that, okay, if it is 1 year, it means in half the year I get 3.625, in half year I get 3.625 again, right? And you get 100 here also last, right? So you discount it, right? You discount it, right? You discount it. Okay. uh, if you're saying that, okay, let me kind of discount it, So the point here is, uh, you are saying 3.625 discounted by your whatever the discount rate is, 1 by r raised to power 1, and you are saying that I will, or this is 6 months, you will say 0.5. Then there is 103.625. You are doing 1 plus r raised to power 1. But what these guys are writing is, these guys are writing in terms of discount factor. So how they are writing it, they're saying, okay, I'll write the cash flow 3.625. Then I am writing discount factor for first time period. Then I'm writing 103.625 into discount factor of second time period. Right? So it is just a way of writing. The concept is not changing, guys. Concept is still discounting. It is just a funny way for write for the first time period, funny way for write for the second time period. The first time period could be anything. First time period can be six months also, right? This representation of 1 and 2 is only uh, representation of a time period, right? This can be 1 year also, right? So these time period could be 6 month time period, right? So it is just a way to write. 3.625 is the coupon. You multiply it with first discount factor. 103.625 you multiply with the second discount factor, right? That's what you do, right? And ultimately you are, using different formulas to get your D2 rate, right? Another discount factor. If you know all other values, you know D1 and all the other value, you're finding D2, right? You are, if D1 is known, you're finding D2, right? Now using D2, a bond, treasury bond with 2 years of maturity can be priced, right? So you can repeat this, repeat this, repeat this. By this way, you can find, see, you use DF1, you used discount factor 1, right, to find your DF2. Now you can also use DF1 and DF2 to find DF3. So point is, if you use previous discount factor, you can make an equation like this, right? 3.625 into D1 plus, coupon into D1 plus coupon into D2 plus whatever, like whatever the time period. You can make this equation equate with the present value and you can find the discount factor, right? So discount factor can be easily find out by this equation, right? Again, very basic kind of concept. If you have any doubt, you can ask. Okay, that is what we are doing here. Now this question, right? Which of the following is closest to the, let's solve this, guys. Which of the following is closest to the discount factor for the 6 month discount D0.5? How will we go about it, right? Anybody has any clue? Like, what will be the logic here, guys? How will be solving it? Anyone? Any idea? What will we do here? How do we calculate the discount factor? Again, see, this is actually one of the questions of your book, right? This is so not very difficult, I'll say, but this is one of the questions of your book, and if you kind of uh, try to understand this, it is not difficult, right? To be fair, what is happening here is that you are using the same principle which we used earlier to calculate their discount factor, right? So what is happening here is that you see the table above, right? When you see the table above, right, and you kind of realize that, okay, the question is asking me to find discount factor for 6 months. If I have to find the discount factor for 6 months, right, basically the cash flow, right, the cash flow or the price, basically you can say the price is 101.3423. The price is 101.3423. Now what do I multiply, uh, you know to get 101.2? See, it's quite basic, to be fair. Your price is given, 101.3423. Right, the price is given. Now you know that the what we discussed right now, right? That present value of a bond is nothing but your cash flows discounted. Please understand. You have been told to find D 0.5. D 0.5 means 6 months. Is focusing here, right? 6 months they're asking, right? So present value is 101.3423. If he has told you to find your what do you say, cash flow, right? So you are saying that, okay, what is the coupon? So my coupon which is coming, there's only one coupon which is coming in 6 months, right? So that coupon which is coming, the coupon which is coming is, if my face value is 100, 5.5 is this thing. The coupon which is coming will be 2.75, because 6 months it is coming, na? 2.75. Whole year coupon is there. Your 1 year coupon is your 5.5%, right? So 5.5. 6 month coupon will be 5.5 divided by 2, which is 2.75. So this is 6 month coupon, right? If this is 6 month coupon, we have, right? So my value becomes what? My value becomes 100 plus 2.75 into your D 0.5. So if I get, basically, my equation turns out this, right? Luckily it has asked me an easy question, right? Had he asked me for 1 year, right, it has asked me for D1, then it would have been tricky, right? But it has asked me very, very simple, under 2.75, which is this value, 2.75 plus 100, so it becomes under 2.75. This is under 2.75, right? And you multiply this with your D 0.5, right? D 0.5, right? So you get the value, right? You get the value. You solve it, you get the value, right? Just, I think that's the answer. You can see the answer also, to be fair. Yeah, that's what it has done, right? So again, please understand, the basic principle never changes, right? Basic principle never changes. Ultimately, okay, I can write down here also. Please understand, if you distill it, right? If you distill it, ultimately, when you look at the present value of a bond, that is nothing but your cash flows discounted. Then now, depending on the time period, right? Depending on time, maybe you can have one cash flow, maybe you can have two cash flow, right? Depending on the time period. In the question, we had 6 months, right? So we had only one cash flow, right? Cash flow one. One cash flow was what? 100 was my face value. The coupon was what? 5.5%. Since it was one cash flow 6 months, divided by 2, it is 2.75. So this value will be added. So cash flow will be 102.75. Now the face value was given to me 101.3423. If the present value was given to me, then my this cash flow is this. Now this has to be discounted. 1 plus R. I don't know how to be discounted, right? So the question asked me this can be written as 102.75 into your 1 by 1 plus R, your 0.5, and I can write it like that. Oh, this is the thing. I can write it like 101.3423 is equal to 102.75, right? Into your what? The discount factor for 6 months. Right? That's it, guys. Very, very simple. Okay. Very basic principle. Nothing to worry. Okay. All right, guys. Now another question. Oh, okay, good. I was telling you, this is tricky. They have given you a tricky question also. Now I have to find D1. Please note, I am going to D1. D1, the present value is this. Present value is 102.1013. If present value is this, now how do I find the present value? I told you, present value of any bond is what? Cash flows discounted. Now, how many cash flows it has? So it has two cash flows. You have CF1, right? And you have CF2. Why I'm telling you two cash flow? Because one cash flow is coming in 6 months, other cash flow is coming again in 1 year. So what is the first cash flow coming? First cash flow is coming. What will be the first cash flow coming, guys? This is where there can be a mistake. What can be the first cash flow, guys? Tell me. What will be the first cash flow? Anyone? Right? What will be the first cash flow here, guys? Here you might go wrong if you don't pay attention. See, since we are talking about 1 year, you have to take this interest rate. Don't consider, no, I will have again 5.5%. No. See, your coupon is this 14%. So if you draw the timeline, your 6 month the coupon coming is, if the total year coupon, see 100 was the value, 14% I have coupon on it. So 14 is my yearly coupon. Now, if 14 my yearly coupon, I have to divide between 6 and 1 month. So 14 will get divided into 7 and 7. So it means at the 6 month I am getting 6 month I am getting $7 coupon, and the last I am getting 107. So my value will come out as, I have 6 cash flow that I am discounting at. Sorry, I have 7 cash flow. 6 month it was there, right? I have 7 cash flow, right? $7 cash flow that is being discounted at your $7 cash flow, right? $7 cash flow that is being discounted at D0.5, right? D0.5, and I have 107 cash flow which is discounted at your D1. Now the question comes is, do we have your D0.5? Do I have D0.5? D0.5 will be taken from the previous question, right? D0.5. The D0.5 which was done in the previous question, we will use that. Okay, the previous question D0.5 was your 0.9863, right? If I use 0.9863 in my calculation now, so I'll get the answer, right? I'll get it. So D will be used as 0.9863, right? So 102.1013 is equal to 7 into 0.9863 plus 107 into D1, right? So I can find D1. Okay. Please note, it is very systematic kind of process, right? It is not like very difficult process. Ultimately, the process is same. You have different cash flow, you discount it. Please note, only objective in your such kind of chapter is so that you are easily able to identify the cash flow, right? So if you look at the cash flow, the coupon is 14%. So cash flow will be 7 and 107, 7 and 107. Then it is D0.5 and D1, right? That's it, and present value is given. Very easy, very straightforward. Okay, just remember that.
So here,
Go on.
we saw there is a 6 month and 1 year. So we assume that is semi-annual, right?
Yeah.
For
Yeah.
that reason, we assume it's semi-annual.
Yeah. Yeah. Right. That's the reason. That's why it is given, right? Maybe the question will give you more elaborate. There would be 2-3 lines above it also. They will tell you it's a treasury bond with 6 months, 1 year, etc. Okay, that will be the thing.
I have a
All
question.
right.
Can you maybe explain again the D05?
Okay.
What is why is this 098?
Okay. Fine. So I'll
Maybe I
solve
miss it.
I'll solve D05 here only, right?
Mhm.
So or maybe I solve here. Right? See, okay, that you will realize. See, ultimately, you are finding your discount factor, right? D05 is a discount factor, right? D05 2.5 is a discount factor. Ultimately, I told you, right? The basic principle in bond market will never change. Basic principle is that present value of any bond, right, is your cash flows discounted at appropriate rate, right? Now, when somebody is asking me D05, so he's asking me about what is the price at D05. Somebody is asking me D05, what is the price in D05? The price is 101.343. So it means present value is given to me 101.3423, right? Now, if somebody is asking me D05, means How many cash flows I have? I have only one cash flow, right? I have only one cash flow which is coming, right? If I have one cash flow coming, how will I decide? See, 100 is my principal amount. How do I find the coupon? Coupon is 5.5%. But this coupon, I told you, this is always per annum, right? If 5.5% is coupon per annum, 5.5% is the coupon per annum. What will be the for year you will have 5.5. For 6 months you will have 2.75 and 2.75. Am I right? 6 months you will have this, na, 2
Yes.
point, right?
Yes.
So you are saying
Yes.
that, oh, if I in 6 months it is coming 100 plus 2.75, right? So plus 2.75. So your value here which is coming is 102.75. So you are saying my present value is this, my cash flow is 102.75, right? I divide it by your whatever 1 plus r, 0.5, but I write it in a discounting way or discount factor way, 102.75 into your discount factor, your 0.5. That's how I calculate. Make sense?
Definitely. Thank you.
No worries, no worries. See, it's an easy concept given in a kind of difficult way, right? You can also find for 2 years, right? Like this, I don't think the question is given for 2 years, but if we want to find for 2 years, we can find for 2 years also. Let's say 2 years is given, no, not given. If I have to find for 2 years, but okay, I can't find for 2 years. That's the reason, because I need 18-month cash flow also. That is not given, right? 18 months is not given. So maybe I have to assume that maybe between 1 and 2 years the coupon is 8.5 only. So that's the case. But 18-month cash flow I also need here, right? This is done, guys. Okay. Now the next part is determining value using your discount functions, right? See, the point which your book is stating is that uh, if two instruments have identical future cash flow, they will lead to your same present value, right? If two identical future cash flows don't lead to same present values, this can lead to arbitrage opportunity, and people will try to use that arbitrage opportunity. Now, when we're trying to price the bond using your discount function, we have to understand that if the value is not coming equal, we can buy the undervalued bond, short the overvalued bond with identical cash flows, and take the profit from the differential, right? So if 2 year coupon bond is underpriced versus your strips, right? Strips is again, another instrument. You buy the undervalued, you sell the overvalued. I think this is arbitrage. I have explained it quite well in your futures forward, etc., etc. I've explained it quite in detail, right? But we'll see the question you will raise more. Point here is, you look at the cash flow, you look at the final price, you try to value your bond using your discounting normal approach of present value of cash flow, right? Whichever bond is undervalued, you buy, right? Please remember simple principle of life. If you find something undervalued, you buy. If you find something overvalued, you sell, right? You find something overvalued, you sell, right? That's what you do. Okay, we'll solve the question, you will realize. Okay, we'll solve the question, you will realize. Okay, we'll talk about your strips, your replicating portfolio, constructing a replicating portfolio, pricing convention between coupon dates, accrued interest, and day count convention. It looks a long chapter, guys, but actually it's a all theory, right? So, and we have to complete 2 chapters today, so there's one more chapter coming your way. Let's complete this, then take a break. Okay. Strips. What is strips? I told you, right? I'll tell you ahead, but just come now. See, when you talk about strips, right? Strips is nothing but a special kind of instrument. The name is separate trading of registered interest and principal securities, right? So it's a famous instrument which is used in market, right? What is done in strips is that you kind of strip something, right? Strip means you kind of uh, a treasury bond, you kind of see a treasury bond has what? Treasury bond, if you think of your coupon, right? Treasury bond has coupons, right? Let's say 5 year coupon treasury bond. So every year there is a coupon which is coming, right? So that's a there's a coupon which is coming every year, and in the final year these are coupon principal. Now if I, let's say, make two instruments out of it, I say I take all the coupon in one instrument and I put the principal in other instrument, right? So this is called your C strip, this is called your P strip. So what are you doing here is that by using a treasury bond, you are getting your coupons per principal. Instead of using at a single security, you are kind of stripping it, right? And kind of taking all the coupons in one side, all the principal in one side, right? And once you do that, right? Once you do that, right? Okay. Uh, you kind of understand, right? You kind of understand that, okay, that what is a C strip and what is a P strip, okay? All right. So that's what you have, right? A C strip and a P strip. You strip it in different principal components and the coupon component, right? Please understand when you kind of strip your, you know, this kind of P strip and C strip. This is a kind of a complex procedure, right? It is not very easy, right? Don't think that any instrument can be easily kind of stripped into its P strip and C strip, right? So it's a difficult procedure, and each of your what do you say, C strip and P strip has different properties, different uses, and once we look at different uses, we realize that maybe these stripping is sometimes beneficial and sometimes not beneficial, because depending on what kind of environment we are in or what kind of situation is, right, depending on that, uh, the risk is there, right? uh, when I say this second line, right, there is a no reinvestment risk, pure zero coupon, right? Point here is that if a conventional coupon bond kind of exposes you to reinvest each coupon at a uncertain future date, when you have a zero coupon instrument, right, that kind of locks in a single compound rate from purchase to maturity, so there is no interim kind of reinvestment risk. When you need to match your known future liability, maybe a pension kind of thing, so a P strip is ideal, right? So no investment risk is for your P strip, right? P strip as right thing, right? And ultimately, if you like to find the market price of your C strip or the market price of a P strip, ultimately, what will happen if, let's say, you're trying to find the market price of P strip, it will be your face value, right? Face value, right, divided by 1 plus y raised to power n, right? Whatever the yield, and you will discount like that, right? Similarly for C strip also, right? You need to do that. Please understand, normally markets are efficient, right? And the price of the bond should be equal to your summation of P strips and C strips, because ultimately these P strips and C strips have come out of your uh, treasury bond, and if you join it back, it should make equal to treasury bond. But sometimes in the market that's not the case, and if that's not the case, buy the cheaper side, whichever strips or bond, whichever it is, and sell the expensive side to lock in your future profit until they converge, right? So understand this point, that P strips are used to immunize, yeah, your long dated liabilities, because they don't have any reinvestment risk. C strip is mostly for cash flow matching, right? I hope it is given ahead. If not, I'll write it down here. Uh, okay, not given here, so I'm writing it down here. Please note that P strips kind of immunize. These P strips are used to immunize your long dated liabilities. C strip, the coupon strip, that is the principal strip, this is a coupon strip. These are to fine tune your cash flow matching. Okay, in the short end. Okay, treasury strips are very liquid in your major markets, but sometimes in some other markets they are not liquid. There are different tax treatment and all those things are also there, but not part of your syllabus. Okay, moving on, guys. Next one is how do you construct a
Sudhanshu,
yeah, go on.
you mentioned to humanize your long dated. What
Liabilities. P
what do you
strip
mean by that?
P strip immunize
Uh-huh.
your long dated liabilities. When I say P strip immunize your long dated liability, it means that, let's say there is an investor who is a big pension fund, right? If there's a big pension fund, they are kind of looking to they know that, see what happens in pension funds, right? Pension fund already know when will their employees retire, right? So they know when is their liability. Let's say a pension fund knows that 2030, right? 2030 July end, right? 31st July, my 10,000 workers will retire. And when my 10,000 workers will retire, I have to start paying their, maybe big gratuity amount or big amount, right? So there's a liability which is there, right, for the pension fund, right? Liability for there. So what the pension fund can do, whatever money pension fund has, they can invest in your P strip for 5 years. Today is what, 2025 now. So they can buy a P strip, buy a principal strip for 5 years. What will happen if they buy a principal strip for 5 years? That in between they will not receive any money. But 2030, when they have to pay their employees a lump sum amount, a big amount, that time the investment which they have done that will materialize. Yes or no? You get my point?
Hmm.
So
Yes, correct.
they have to make a payment outflow, all right, but they are themselves getting an inflow from P strip, na. So this is immunization, right? So you
But
are,
then,
yeah, go on.
yeah, but then what is the benefit? I'm blocking my fund for 5 years.
Yeah, so see, fixed income, you are, when you lock for a longer period, you get better interest rate, na. So when you see there is no coupon, see, the point is when
Okay, so
you,
it is like zero coupon bond.
so it is giving you payment only at that time. Yeah, zero coupon bond, right? It is a zero coupon bond which is giving you payment only at that time. There is no coupon in between, so there is no reinvestment risk in between. Okay, because other coupons, what will
Okay.
happen? The money will come in between. Then you will be always worried that will I get the same interest rate or not? Right? Will I be able to invest at the same interest rate or not? So you have to do again and dynamic adjustment, etc. Here it is good now that you directly put your money in the 5 year, and it is whenever your liability is due, that time your principal strip is also due, and you're balancing your liability with the principal strip. Make sense?
Yeah, I understood.
Okay.
But then
No
how
worries.
this is different from your typical zero coupon bond?
No, it is not
Why
different.
this instrument is in place?
This instrument is
Okay.
in place because you are, zero coupon bonds are not easily available now. Who issues zero coupon bond? Zero coupon bonds are usually issued by companies which are in distress, right? Because they try to issue,
Correct.
right? But here we have created zero coupon bond from a treasury bond. Treasury bond is a very safe
Okay.
instrument, na? Right?
Hmm. Right.
So you're not worried about. See, if you take a other zero coupon bond, what if the company defaults, company goes bankrupt, then what?
Right.
Right?
Correct.
So here, if
Hmm.
you are creating a zero coupon bond artificially, synthetically from a treasury bond.
Treasury bond. Okay.
Right? So
Understood.
that's a very
Fine.
safe,
Yeah. Yeah.
very safe instrument, na? Okay.
Right.
Right.
Right. Correct.
No worries, right? Okay. All right, guys. Let's move ahead, right? So that's the advantage. Now we are talking about constructing a replicating portfolio. What do you mean by constructing a replicating portfolio? Basically, we are trying to figure out that how do we construct a portfolio which kind of mimics, right? Which kind of mimics the cash flows, uh, the cash flow of a certain bond using other bond, right? Again, it's just you can say financial engineering, right? You are replicating a bond's cash flow using other bonds, right? You are trying to figure out that how do I do it, right? So ultimately, the point here is you can use P strips, C strips. You can use zero coupon bond, right? You can do that, right? Why do you want to replicate? Because first of all, you also know that there is no arbitrage pricing. If your portfolio uh, of substitute cost less than the target bond, you can buy the cheaper side and sell the expensive side. It can also help you infer your zero coupon rates, and it also helps you in comparison, right? So we'll see ahead how it is done. Nobody will tell you to replicate in the exam, but you should be able to compare it, right? So goal is to replicate, identify bonds to replicate, match the cash flows using other available bonds, solve backward from the last point. If total price of replicate portfolio is equal to target bond, not equal to target bond, there is the arbitrage. So when there is the arbitrage, buy the cheaper one. If there is a arbitrage, buy the cheaper one, sell the costlier one. Right, buy the cheaper one and sell the costlier one. Okay, that's what we have. Moving on. Okay, this is a replicating of bond portfolio, guys. This is an example given, but normally such kind of question don't come in exam. They will give you the value itself, and then you have to compare it, right? This is just the illustration they have done. What they have done is, suppose there is 2-year fixed income security exists with $100 face value and a 10% coupon rate, right? The coupons are paid on a semi-annual basis, and the securities YTM is assumed to be 4.5. YTM is yield to maturity, right? So what YTM 4.5? I told you, right? Since a semi-annual basis, I by Y will happen to what? I by Y return, whatever is I by Y means YTM. YTM will be divided by 2, right? Coupon will also be divided by 2. Your time periods, right? Time periods will be your multiplied by 2, right? Multiplied by 2. The time period became 4, right? This is 1, 2, 3, 4. Coupon became, so if you make a timeline, the time period became 4. 1, 2, 3, 4, because 2-year was a thing, semi-annual into 2, time period became 4. Coupon coming is divided by 10% is the coupon divided by 2, it became 5, right? This is also 5, right? This is also 5, it is coming here, and this is your 105. Then they are giving you YTM. YTM means the yield you have. ITM is your 4.5. YTM will come as 2.25. Your discount, right? 5 by 10225, 5 by 10225 square, 5 by 10225 cube, 105 by 2254. You calculate 110.41 value. Now bond 1, right? If somebody wants to replicate bond using appropriate face value of bond 2, bond 3, bond 4y, right? So these are the 4 bonds which you want to use to replicate it. Now, what is the problem with these 4 bonds is that all these 4 bonds which we are using to replicate, we are trying to replicate, right? There is a coupon 7%, coupon 12%, coupon 5%, coupon 6%, right? So we have different coupon, and once you see yourself, even the present value is different, guys. See, 101.22, 107.25, 100.72, 102.84. So not only the coupons are different, the present value are different, face value is same, time horizon is same, right? So what we are trying to do is that can we uh, you know do something to replicate the portfolio. Again, I'm telling you this question, nobody will tell you to replicate in exam. No one will tell you to replicate. No one will tell you. This is just a illustration, because replication takes a lot of time. No one will tell you to replicate, right? What is the expectation out of you, that you can judge which is costly and which is cheaper, right? So this is just an illustration that you will take bond one's cash flow, right, which is 7% like this. You will take bond another cash flow, and then you try to calculate different values. But again, this is just an illustration. Don't bother about this thing. More of a practical kind of this thing can be done in Excel. more of a Excel kind of thing here rather than a FRM exam kind of thing. Okay. Now we are moving to your pricing conventions between coupon dates, right? Again, I told you, right? Conventions are convention. Conventions are what people follow, right? Now, if somebody will say, why in India we drive on left hand side, why in US we drive cars on right hand side, right? So there is no logical answer to this, right? India was became independent from UK, right? British, right? And since India became independent from UK, we took the systems and conventions from the UK, right? So UK, the system is that in UK you drive car on the left hand side. So India also will drive car on the left hand side. But in America, car you can drive the car on the right hand side, right? So conventions are like this, right? So conventions are whatever people are following, you have to follow, right? So that's the whole case. Bonds often trade between coupon dates, that we know. Prices must include your interest earned since last coupon, that we understand, right? There is something called clean price, right? Clean price, right? There is something called your dirty price, right? Please understand that there are two different prices which are used in market, right? We need these, both prices are used in the market, right? So that's why we have to understand that clean price is also called as your quoted price. Please understand, clean price is also called as your quoted price, right? Right. And dirty price is clean price plus accrued interest, right? Dirty price is clean price plus your accrued interest. I'm writing AI, right? Accrued interest. Just remember, why do we have such weird terminology? Because this is how it is used in the industry, right? It is, people talk like this, so we are using like this, right? People use clean price in their conversation, we use it, right? When a bond is sold between coupon dates, a buyer pays seller for interest accrued up to settlement, right? Simple point here is that, let's say, right, somebody, let's just imagine, right? Somebody bought a bond on, let's say, 30th of June, let's say 30th of June, right? And it's a semi-annual bond. Next, so he bought it here. So he bought a semi-annual bond, and he was expecting that since next 6 months means 31st of December, right? He will get a coupon payment, right? Now, maybe something happened. Today is your 20th of July, right? Today something happened that the person is not happy, right? Person has some financial constraints, right? And person decides, no, 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 I'm not happy, I have some financial constraints. Okay, let me kind of I want urgent money, let me sell it. So but when he goes to the market to sell it, right, whatever price he sell it, that is different, right? But the point here is that the person will say na that, see, if I held the bond for 180 days, right? If I held the bond for 180 days, I would have got a coupon. Let's say, just for ease of understanding, you will say, let's say it's $1,000 coupon with 10% interest. So he's saying, right, that coupon is coming semi-annual. So total coupon is 100. Every semi-annual coupon is coming 50 and 50. The person says, let's say person is Mr. A. Mr. A says that, see, if I held the bond for 180 days, I would have got a coupon of 50 rupees. Out of 180 days, due to whatever my financial circumstances, I'm not able to hold the bond, but I held the bond till 20th of July. 20th of July roughly means almost 50 days. So he's saying that, see, I held the bond for 50 days, right? I am selling to the person who will hold the bond for 130 days. Okay, who will hold the bond for 130 days for next coupon, right? For next coupon, he will hold the bond for 130 days, right? So point here is that Mr. A will say that, see, I held the bond for 50 days, right? Out of 180, right? So I should be compensated for this period, right? So he's basically saying that 50 by 180 is the my holding period, and coupon for 180 days, right? Coupon for 180 days is your what do you say? Coupon for 180 days is 50. So I should be compensated for, if 180 days holding gives me 180 days holding gives me $50 coupon, right? 180 days holding. 1 day holding should give me 50 by $180. 50 day holding should give me sorry, uh, yeah, 1 day should give me 50 by 180. 50-day holding should give me 50 by 180 into 50, na? So he's saying that give me this much coupon, right? So in the market, he will always ask for this accrued interest because, and he's right, right? By the principle, he's right because he's saying that see, if I held for 180 days, I would have got 180 days. I would got 50. 1 day, if I have held 50 by 180, 50 days I am holding 50 by 180 into 50. So I should get coupon of 2500 by 180, which can whatever is the value here, right? But person is demanding that much interest. This is called accrued interest, guys. And this is the concept of accrued interest, and this is what is added to the quoted price, right? That quoted price is what is quoted on the market, and then you get the dirty price. So accrued interest varies from person to person. The holding period is different from person to person, right? That's what we have, right? So this is what I told you, right? Same principle I told you. Same thing they are explained here, which I explained you already. $1,000, 10%, $50 every 6 months, 90 days elapse. He's saying, give me 90 days by 180, right? Give me 25 days coupon, right? Buyer pays this accrued interest to the seller, right? Same concept I told you, right? Okay. Moving on, guys. Day count convention, right? Day count convention, I told you, right? If UK drives on left side, India drives the car on the left side, US drives on the right side, we can't question, right? So these are the convention which have been established in the industry. The convention established in the industry is that you have your actual by actual convention for US government bonds. So US government, and you have to remember it, guys. Please understand, nobody will come and tell you these conventions, right? Please remember, right? Please remember, expectation in the exam is that the question will be given to you, US government bond. That time, don't say that what will be the convention. The expectation is the question says US government bond, you know it is actual by actual. Question says US corporates or municipal bonds, you know it is 30 by 360. Right? Question says money market, you know it is actual by 360. Question says bond in Canada, New Zealand, Australia, you know actual by 365. What you need to remember is these threes are very common. First three are very common, guys. The question will come money market, a person is trading in money market, right? Use third one. Person trading US corporate municipal bond, second one. Person trading in US government one, first one, right? So you have to use this thing, right? Please understand, fraction is okay that I have calculated. I told you, right? That also days since last coupon. Impacts your accrued interest, pricing between coupon dates, adjust the denominator in the accrued interest formula based on the standard day assumptions, right? Whatever the assumption we will use. Example is 30 by 360. You understand that, okay, you will take 180 days for one period, right? When it's actual by actual, you will take actual days. Actual days is 31, you will take 31 days. Actual days is 29, February month is 28, you will take 28 days, right? Please remember, easy to remember, please understand. See, government, when you are dealing with government, things normally work actual to actual, right? You take actual date to actual, by actual to actual, right? Actual to actual. Your corporates and your muni is municipal bond, guys. Corporate and muni is your 30 by 360. Okay. When you are getting into money market, right? Money market is your short term, right? Money market you are getting is, then it is actual by 360. Okay. Nobody will tell you this thing, guys. You have to remember and use it. And examiner will, you will say that, oh, my answer will not change. No. Don't take approximate answer. What will happen is they will give you an option which is by other way, and if you choose the wrong one, you'll lose the question, right? Which of the following day count convention, right? This kind of question doesn't come in exam, guys. To be fair, which of the following convention would most likely be used in pricing in Australian money markets? Australian, you have actual by 365, right? Australian, that's what we have. Australian, right? Actual by 365. Australian, we use actual by 365, right? Australia, Canada, New Zealand, right? C, right? That's what we have. Question number 4: a euro $1,000 par value, right? French corporate bond pays 3.5% coupon with a semi-annual frequency. Okay, fine. Assume the last coupon was paid 75 days ago, right? And there are 30 days in each month. The accrued interest we have to calculate, guys. Please understand, it's a French corporate bond, right? It's a corporate bond, right? French corporate bond. What will we use here, guys? First of all, what kind of convention will be used here? It is a French corporate bond. What do you think is the convention here? Tell me. It's a corporate bond. I
30
understand.
by
Hmm.
30 by 3.
30 by corporate bond is
360.
30. Corporate bond is 30 by 360, right? That's true. Corporate bond. See, France is not different. France, Europe, etc. follow same thing, so that's okay. France is not different, right? The corporate bond, the Canada, New Zealand, Australia are different. So 30 by 360 we will use here, right? 30 by 360 will be
But
the, yeah.
but but is will the country matter here because it's corporate bond, right?
Yeah, it's a corporate bond. In country will not matter. That is for money market also, right? Yeah, country will not matter. To be fair, country will not matter here because that was only for your, see,
Australia, Canada, and New Zealand.
yeah, there it matters, but other countries doesn't matter. Canada, New Zealand, Australia, it matters, and
But
that doesn't come normally, right? They will ask you. Uh, like rarely they ask you on Canada, New Zealand, Australia. Normally they ask on US only, right? So main point is you just remember corporates. Corporate is 30 by 360, right? That is more important to remember. Okay, so corporate pays you 30 by 360, right? So now if you have 30 by 360 convention, right? 30 by 360 convention, right? Somebody asked something. Um, yes, that. Maybe no somebody if there is 30 by 360 convention, right? So what is the thing here we are getting? With we have 30 by 360 convention, it means again the coupon is semi-annual. See, if you have 30 by 360 convention, the coupon is semi-annual. One period, basically semi-annual period. Semi-annual period will have basically now 360 is the full year. Semi-annual will use 180 days. See, this is what why we need to know the convention, because that convention will decide what how many days will be in your semi-annual, right? So semi-annual is 180, right? Now assume the last coupon was paid 75 days ago, right? There are 30 days accrued interest. So we have what, 75 days already out of 180, right? So 75 days passed out of 180, right? If you have 75 days passed out of 180, that is the thing. Okay, and now if what is the your amount, what is the coupon we have? So we had what, 100,000 by the principal amount. This is 3.5% coupon, but I always told you that 3.5% is always per annum. So it will be half. 3.5% divided by 2, right? Divided by 2. So it comes out 1750, right? So it will be 1750 was your coupon, right? 1750 was your coupon, right? You got it. That coupon will have accrued interest. So 1750 coupon will have interest of 75 by 180, right? So you understand here that if you had not known the convention, you had not been able to take the correct date, 180 days, right? And then this is fine. This coupon calculation is fine, which is just the principal amount into the rate. Rate, please remember, this is always per annum. Semi-annual, you have to divide. I told you, right? Semi-annual, your rate I by y, the interest rate gets divided by 2. Your quarterly O will be divided by 4. Your number of time periods multiplied by 2. Your coupon divided by 2. Right. So remember these things, that these things happen. Right. So I think this is the answer. Let's see whether this is the answer. Yeah, 1715 to 75 by 180. Okay. So that's it, guys. We have completed this chapter, but today is a longish day. We have to do one more chapter, right? That's in our plan. We have to do interest rates also, where we have to do compounding, spot, forward par, swap rates, yield curve shapes. So very important chapter ahead also. So heavy day we have today. Overall, what I'm trying to suggest here is that in this chapter, if you want me to kind of tell you what will come, like what is more important here, uh, no direct question to be fair, right? No direct question to be fair, but bit of idea how cash flows are taken, right? How your discounting is done. Maybe remember this formula, but normally it doesn't come, right? That's how it is done. How understand coupon divided by two, I by y divided by two, time period multiplied by two. That's the concept. Then what is the relationship between price and yield? What is duration, convexity? A little bit of idea. Linear is duration, curve is convexity, right? Discount factors. Yes, discount factor. This part is interesting. You can do this. How you calculate D05, right? What is this cash price? This formula comes directly sometimes. They will give you Q, they will give you N as the cash price. So remember this formula, right? And then you have your what you say, yeah, D01, which we have seen, right? You do this calculation, D0.5, one numerical we did for D0.5, one numerical we did for D1. This is very vital, right? This is again some theory here, not much. Strips, just the definition. No, what is a P strip, what is a C strip, just the definition. Replication portfolio, more of theory. You can't solve such kind of numerical in exam because such kind of numerical cannot be asked in exam. This is more of an Excel based kind of thing, guys. So you this looks very tough, but please understand that there can be no question asked here, right? Because this is an Excel exercise, right? So this is good exercise, but this is more of a Excel exercise. So from knowledge perspective, this is a very good concept, but from exam perspective, nothing will come here, right? No one will tell you to replicate, right? Exam perspective, knowledge perspective, good to learn. Exam perspective, you won't get anything from here, right? Just remember that, because not easy to ask question. Conventions very important. This also very important. Clean price, dirty price, accrued interest, right? These are very important concept in your exam, right? Accrued interest we have calculated. Conventions very important. I told you how to have use conventions. That is very important. We solved a question, right, on conventions, right? This one. Okay. So yeah, so we are done.
Shanku,
Yeah, go on.
if you go back to the last slide,
This one.
yes,
Mm-hmm.
the first line says a euro 100K
Thousand.
par value.
Par value.
Yeah.
Yeah. So
So
basically,
is
yeah, go
this
on.
par value? So my question is this statement, par value,
Hmm.
is it very important with respect to the question that we solved?
No, it is not very important. The reason is, see, par value only tells you whether the bond is trading at a premium or discount, right? Par value, discount value only comes into picture when you are looking at something is trading at a when you're trying to find what is the price of that thing in the market, right? So when somebody says, basically concept is very simple, right? So concept here is that when I say par value means that my uh, whatever my bond is, right? The current market price, right? Par value means that if my bond was, let's say, 100,000 rupees, the current market price is also 100,000 rupees. That is the meaning of par value, right? If I say it's a discount bond, it is discount. A discount bond means that the bond was issued at your 100,000, but current market price maybe is 99,500. So current value is lower, so it is trading at a discount. When I say premium bond, right? Premium bond means the bond was issued at $100,000, but maybe people like the bond very much, and bond's current market price is your 100,500. So it means only this much, right? So it doesn't matter par value. If they had given us your discount bond or your different things, then also we would have calculated our our interest, right? Our interest only on your 100,000. Why? Because the interest, the coupon is always on face value, right? So basically, this is your face. This 100,000 is called face value, right? So you always calculate your coupon on the face value. Right? You always calculate coupon on your face value, right? You never calculate coupon on your any other value, right? So a par value just tells you that okay, current market price is equal to this price, but we always know that we have to calculate on the face value, so it doesn't matter.
Okay.
Okay, makes sense.
One more question. Yeah. One more question. See, we are talking about bond. So bond is a fixed instrument, okay, fixed income instrument. So
Right.
when the bond was issued at say 100 as a face value, okay,
Mhm.
uh, later it would have traded in the secondary market for XYZ amount, right?
Yeah. Uh,
And that defines whether the bond is trading at discount or premium.
yeah.
Okay. So so my question is that what drives that bond? Because the coupon remains the same, right? If the suppose it's a corporate bond, the corporate has said that I'll give you 10% per annum as a coupon, correct?
Okay.
So the coupon will remain the same. Then what drives the bond price?
Okay. Fine. Good question. Like very interesting question. Very conceptual question. Right. Let me make a last. Let me put this in last slide. Right. Last slide. Okay. Very interesting question and very conceptual. And this is basic doubt among people also. See, the point is, let's say today is 20th of July. Right? Today is 20th of July. Right? 20th of July 2025. Right? Today, 20th of July 2025. Let's say a bond was issued. Right? Bond was issued. The face value of the bond was kept at, let's say, 1,000. Right? And bond was issued at your I by Y is basically your yield, right? Yield is written. I write I by Y because in calculator it is written as I by Y. Right? I by Y. Let's say the bond was issued at, and let's say it's a US bond, right? Let's keep it international bond, US bond. So it was issued at, let's say, right now US Treasury yields are around 4.2%. Let's say it was issued at 4.5%. Let's say right? 4.5% for 10 years, right? Now, when you think of bond market works on many different things, right? There is always your inflation expectation. There is inflation expectations, right? There is inflation expectations, uh, people, right? So there is inflation expectation that drive the bond price. There is spreads. Spreads means nowadays whatever policies I'm taking a US bond like President Trump is taking, right? So if dollar is becoming a safe haven, the spread will decrease. If dollar is not becoming a safe haven, spread will widen. So inflation expectations, spreads, all these things kind of affect, right? Basically, what is the see bond is based on the person who has issued, right? The issuing authority matters a lot when you talk about your bond, right? Whether it is, here I'm talking about US government, so issuing authority is US. So the credit worthiness of the issuing authority, if that goes down, the bond price will fluctuate, right? So the price of the bond, let's say you take another corporate bond, right? Let's say the bond of Apple, right? If you take the bond of Apple. Now, depending on Apple's, financial performance, issuing authorities creditworthiness. So Apple's, your creditworthiness, right? I'm writing CW, I'm writing creditworthiness, right? Apple's creditworthiness, it is very important, right? So bond prices fluctuates due to these factors. But are these the only factors? No, there are many other factors. Let's say, let's say in the market, let's say 3 months later, let's say on 20th of October 2025, there is another bond. There is another bond, right, which comes from US government only. Same here also, US bond, US government only issued bond. Here also US government only issued bond. Another bond US government issued. Now same case here, the face value is 1,000, right, and I by Y, right. The interest is they are issuing, let's say 5%. If you are getting more yield, right, will people buy this bond A or will people buy this bond B? You tell me. On 21st
Bond B.
October, bond B, na? Because people want more in return, right? If people want to buy bond B,
Correct.
same issuer, US government only. Now US government is issuing at 5% for 10 years only. So everything is same. This bond has come in the market. So suddenly demand is high for this, na? When demand is more for this, the price of
The
this
price
bond, right?
will
Right?
go high.
Yeah, so this will price will increase. Whereas the demand for this bond will, what will happen to demand of this bond?
It
What
will
will happen?
reduce.
Right? Demand will
The
reduce.
price will also reduce.
Right? Price will lower. Now here also a lot of students get confused. They say, sir, it is very contradictory. They say, sir, you just now told in the starting of the class in price yield relationship, you told that when the I by Y interest goes up, the price should go down, na? I told you this, na?
Yeah,
Right?
yeah,
So,
interest is going up, but in this case, right?
so here I'm saying, in this case, you are saying, sir, here interest is also going up, price is also going up, right?
Mm.
Right? Then you will say, sir, it is contradictory. No, it is not contradictory. That is where students miss out. See, the point is when the new bond comes in, the price of that bond goes up because demand goes up. The, if the interest rate goes up, the price of new bond doesn't come down. The price
The
of
price of
old,
old bond will come down.
yeah, the price of old bond comes down because people rush towards new bond. When interest rate is increased, this is the basic doubt which a lot of people get. When interest rate increases, people rush towards new bond whose prices increases, but this is new bond interest rate higher, the price of the old bond comes down. Price of old bond comes down. Okay, make sense? Normally we read only this much, and people think that, oh, it means interest rate rises. See, interest rate is rising in this case, B case, that is affecting A case. Interest rate increase of B is affecting the price of A. Got the idea?
Yes.
Yes. So these are the factors.
Thank
There
you.
are many factors, right? Bond market is very tedious, guys. Very tedious, right? There are inflation expectation, there is spreads, there is creditworthiness of issuing authority. There are these kind of things which are new bond is issued, right? And similar thing, opposite thing you take. Let's say US government issue 3% bond, right? Then people will say, no, why should we buy 3% bond? People will start buying this bond more, right? This bond more, right? And that will push that price, right? So it is always like, oh, it's always a comparative thing which is going on in the market, right? But yeah, it's a typical
But
case.
the coupon that I will receive would be on face value only, right?
Yeah, coupon will be face value only. Coupon what you will see, that will be on face value only. There will be no effect on your coupon. You will receive the same coupon. If you have been promised 5% coupon, till the end you will get 5% coupon only. It doesn't matter for you. This price is increasing, decreasing for people who are trying to buy and sell in the secondary market.
Correct.
right? Not for you. You have bought it at 5%, your coupon will remain same. But some people are trading on the bond, na? This price and
Right.
going up and down for traders on the bond, not for people who have bought the
Correct.
bond. Got my point?
Understood.
Okay. All right, guys. So this
Hmm.
chapter is done, guys. I know this. It takes time to have that understanding, but glad you guys have it now. All right. So now we have to take a break, guys, because next chapter is also long. All right, guys. Thank you.